So are landlords going to be hit with the 25% corporation tax rate that's due to be in effect from the 1st of April 2023? Closed investment holding companies, they're all caught by this. The main rate applies, which means you get no £50,000 threshold. It's 25% straight away. Are property investors caught? Watch today's YouTube video to find out more. But first, please make sure you do give this video a big thumbs up. It only takes a second. And also you are subscribed with notifications turned on. Hi guys, welcome back to my YouTube channel. Today we're talking all about the tax increase for corporation tax purposes, which is the tax that limited companies pay. We're going to run through how it works to property businesses, and what opportunities there might be around it. So a couple of months ago, Rishi Sunak announced this new tax increase that's going to come in effect from the 1st of April 2023, and essentially it's 25% is the corporation tax rate. It's called the main rate on profits over £250,000. Now, businesses that are smaller than this, if your profits are less, it's your augmented profits that get taken into account for this purposes, are less than £50,000, then the corporation tax rate on those profits will be 19%. So profits between the £50,000 and the £250,000 mark, you get relief essentially equal to about 3/200ths of the difference between the profits and the augmented profits, I think it is. But the long and short of it is, profits between those thresholds, you're actually paying an effective tax rate of 26.5%. So it's all well and good the Chancellor stating that this new headline tax rate is 25%. No, it is not. It's 26%. For profits in this threshold, in this element, basically in that band between £50,000 and £250,000. So it's important you know about this, and important you budget for this, because taxes are going up. So let's jump into this 25% in a little bit more detail. Well, for most businesses, you're a closed company, and what this means, it's owned by 5 or fewer directors who are participators. Most companies in the UK, especially property businesses, are closed companies. And also, if the business is holding investments, which most people do for buy-to-let, for property income, I've heard many people mention that it's the 25% rate that applies. You don't get the £50,000 threshold at all. It's just 25% on the profits. So essentially, the closed investment holding company could potentially catch a lot of landlords out. However, there's one massive exemption, and it's under Corporation Taxes Act 2010, section 34, and broadly this is what it states. So it's got: a company will not be a closed investment holding company if throughout the accounting period exists wholly or mainly for the purposes of investing in land or interests in land where the land is or it is intended to be let. So what this means is that for people who buy properties to let them out on a long-term basis, you will be eligible for the small profits rate of the 19%. I know a lot of early and small property investors who have got a limited company with a couple of buy-to-lets in, you will benefit from this because you won't have profits over the £50,000 mark, especially once you take into account your salaries. And if you're a married couple, you're taking, say, £20,000 of salaries out. That's quite a good property portfolio to be able to produce that level of income. However, for landlords who are bigger than this, obviously you will be suffering from the 26.5% rate as profits go through that tier system, and then 25% over and above that. But it's very important to know that this does apply, because we've seen it before where people are incorrectly saying that because your business is basically it's a closed company, yeah, and it's an investment company because you're making investments in property, then you are not getting this. I've seen a lot of accountants, a lot of other advisors stating this, but now you've got the legislation. It's Corporation Taxes Act 2010, section 34. Make sure you write this down. If you see that your professional advisors are not giving you that small profits threshold, because that 19% compared to the 25% or even the 26.5%, that could be a massive saving. You're looking at a good £3,000, £4,000, £5,000 in tax potentially, which you might be paying extra if your professional advisors don't get this right. However, it's important to note there's no exclusion under section 34 if you do let your properties to a connected person. So this is any of the connected companies, or also your relatives, or spouses of relatives. So if you're letting property to aunties, uncles, brothers, nieces, things like that, in that case, you then become a closed investment holding company, and you basically would have the extra tax to pay based on the 25% rate. So make sure you're avoiding this where possible, because it could have some pretty significant tax consequences. So I want to talk to you a bit about the £50,000 small profits threshold as well, and also the £250,000 limit before the main rate kicks in at 25%, because this is divided by the number of associated companies. And what this means is any 51% group companies, so where that limited company owns more than 51% of the shares in other companies, or they're under control of a group company that also has all these 51% shareholdings, or an individual where the shareholdings are the same. This is going to catch a lot of people out, where you've got property businesses, trading businesses, SPVs, development companies, people who have a lot of limited companies, and broadly all these limits are divided by the number of companies you have. So it's quite easy to say, for instance, for somebody to have 5 companies set up. What's going to happen is these thresholds, the £50,000 and the £250,000, are going to be divided by the number of companies, meaning your small profits threshold is now just £10,000 and your main rate threshold is now just £50,000. Obviously you will still have the amount in between where you'll get the marginal relief, which would basically mean that your profits are taxed at 26.5%, but it's important to note that all of these thresholds are reduced by associated companies, so it's not the £50,000 thresholds for the vast majority of people, because property investors and business owners usually have more than one limited company. Although dormant companies are excluded from this, so make sure that if you do have companies that aren't trading, or if there's not anything much going through them, make sure they are dormant according to HMRC, because it will result in you having that increased small profits threshold for when it comes to calculating the corporation tax. So a practical pointer now, when it comes to making sure that you are maximising the small profits threshold, because that's what we're going to need to do in order to minimise the amount of tax you're paying overall. Previously, where you had companies where you had a husband and wife shareholding, for instance, across the board, because now they would now be caught under the associated companies rules, it's going to be prudent to look at having different owners of different limited companies potentially, just to make sure that companies are not associated, and that each company has its own £50,000 small profits threshold, where it's going to be taxed at just a 19%, and then it's going to have the new higher band as well. So that's definitely something to watch out for, because it's the main thing you want to look out for is that £50,000 mark, and you want to try and preserve that where possible. So if you previously had a property company and a trading business, perhaps changing the share structure so that one spouse owns one and the other spouse owns the other might be advantageous when it comes to trying to circumvent and trying to make sure you stay as tax efficient as possible in light of these new small profits and the increased corporation tax rates. So unfortunately, this is just the start of things to come. Taxes really are going up, up, up and up. Who knows what we're going to see on the autumn budget. As you can be aware, I will be posting updates on Facebook, on social media, and we'll also be in a YouTube budget video as well when we get the information. I think it's the 27th. So it's going to be long anticipated. A lot of things could change. Fingers crossed, a lot of the valuable tax reliefs stay the same, especially for landlords been hard hit with Section 24, the additional rate stamp duty, now corporation tax is going up finally when we've all got SPVs set up. It's going to be an interesting one to watch. Hopefully things don't change too much, but who knows with these things. As you're aware from previous budgets, anything could happen. Entrepreneurs relief could be slashed again, capital gains tax could be going up, inheritance tax reforms. Nothing is off the cards with this budget. The government are looking to recoup as much money as possible from the COVID overspend. Who knows what the figure is now as to how much they've actually spent on COVID, all the furlough frauds, bounce back loans, test and trace, all of these kind of government activities which have cost an absolute fortune. All of this money needs to be repaid, and it's unfortunately on us as taxpayers. We're the only way the government are able to recoup that money, and it's all through taxes. So make sure you are following this channel, because we're going to be posting regular tax updates, tax saving tips and tricks to help you stay ahead of the tax man. I really hope you've enjoyed this video. As always, please do take the time to give this video a big like, because it really helps, and also subscribe with the notifications turned on so that you do not miss out on any videos we post. I've got tons of fantastic content on the YouTube channel, so please do take a couple of minutes to look at other videos that might interest you. Hi guys, I would just like to take a minute to tell you about TaxFlix. I'm sure you've seen basically the tax saving content we are putting out on TaxFlix. It's really having a big impact when it comes to people understanding tax and using this knowledge to empower them and basically build a bigger and more profitable property business. One of the first courses has been launched. It's all about how to structure your business, limited company structures, partners, trusts, smart limited companies, tax smart companies, all of this kind of stuff we've jumped into on there, giving you the concise information you need to know as a property investor to stay ahead of the curve and be tax efficient. We've got courses there from fantastic prices. For anybody who's watching this YouTube video, we're going to give you 50% off the How to Structure Your Business course. All the codes are and the details are all in the description below. Make sure you take advantage of this. It's a very low cost. I think even full price it's £50, but we're going to give you 50% off, so it's just £25. It's absolutely fantastic value. Easy to run through online course, study at your own pace. It's really good. We've had lots of fantastic feedback so far when it comes to people learning new stuff and actually implementing this with their professional advisors. And we're chartered tax advisors. We've put this into a course for you to work with your accountant when it comes to structuring your business.